What if I told you that the keys to building a billionaire mindset aren't locked away in some secret vault, hidden from plain view? What if they're actually right there waiting for you, kind of in plain sight? Because that's really the surprising truth. Wealth and the incredible success that often comes with it. It isn't just about spreadsheets and market timing or some secret formula only the elite get. It's fundamentally about a profound shift in thinking. Today, we're taking a deep dive into what we call billionaire mindsets. These are the mental frameworks, the decision-making systems that have shaped legendary investors and entrepreneurs. Think Warren Buffett, Ray Dalio. We're going to open up 5 investing classics that have fundamentally changed how the world's most successful individuals approach money, business, and honestly, life itself. Our mission. Well, it's to unlock surprising facts, share timeless wisdom, and crucially, give you actionable nuggets you can start using, like this week. This isn't just theory. Think of it as an owner's manual for a richer life. Welcome to the Deep Dive. Our mission today is to unpack a foundational library of investment wisdom.
Basically giving you a shortcut to being truly well-informed. You've shared these incredible sources with us, summaries of 5 books that are really considered cornerstones of financial understanding. They shape not just how people invest, but how they think about building wealth.
Yeah, and what's truly fascinating here is how these books, written across decades, by people with pretty different approaches, they still weave together this tapestry of principles that, they just transcend market cycles.
Yeah.
From the real discipline of value investing to the qualitative hunt for growth, and then on to this very systematic approach to life and wealth. These aren't just isolated ideas. They really work together. So we'll be distilling their core philosophies, sharing some memorable anecdotes that really bring these ideas to life, and most importantly, giving you concrete steps to apply these insights in your own life.
Exactly. We'll explore questions like, what kind of companies should you even be looking at? When exactly should you buy them? That's a big one. How do you even begin to think about managing risk effectively? Which, let's face it, is key. And beyond the numbers, we'll dive into how to develop your financial IQ and maybe the most universal lesson, how to build a really robust decision-making system you can apply anywhere, not just investing.
Right. So our journey today will take us through each of these 5 seminal books. We'll dedicate a focused segment to each one, really distilling their core wisdom, but we won't stop there. Once we've laid that groundwork, we'll combine their wisdom into these powerful cross-book power moves. We'll show you how these seemingly individual concepts actually reinforce each other, creating an even stronger, more resilient approach. And finally, we'll give you a chance to weigh in. We've got a poll and a Q&A prompt to get your thoughts and your action plans.
Sounds great. Let's get started. Okay, let's unpack this with a book that Warren Buffett famously calls the best book on investing ever written. Benjamin Graham's The Intelligent Investor. Well, it's way back in 1949. So this isn't some hot tip guide, right? It's a profound framework for a lifetime of disciplined investing.
That's the key. It truly is the DNA of value investing. It emphasizes enduring principles over, fleeting market trends. Graham's work is foundational because he wasn't just telling you what to do, but really how to think about the market and your role in it. His philosophy centers around, maybe 4 core pillars, really.
Okay, let's break those down. The first one seems crucial. The difference between investment and speculation.
Mm-hmm.
Graham draws a very sharp line here, doesn't he?
He really does. For Graham, investment requires, first, thorough analysis. You have to do the homework. Second, safety of principle. You can't afford to lose your base capital. And third, an adequate return. Not necessarily a spectacular one, but adequate. Anything else, anything that doesn't meet those 3 criteria, that's speculation in his book.
So it's not that speculation is inherently evil.
No, not at all. Graham's point was more about avoiding confusion. He argued that most market mistakes, most financial pain really happens because people don't know which game they're playing. They think they're investing, but they're actually speculating without even realizing it.
Oh.
The remedy he offered is, pretty straightforward. Have a clear policy statement for your investments. Define your risk limits. What returns do you realistically expect? How long do you plan to hold? Just doing that sets a critical mental boundary. It forces clarity, discipline. It basically protects you from your own impulses.
Right. Setting the rules of engagement. Then there's his most famous concept, I think, the margin of safety. This is about buying something for way less than it's actually worth.
Yeah.
Right? Buffett talks about this constantly.
Precisely. Think of it as a A built-in buffer, a protective cushion. By insisting on a wide gap between the price you pay for an asset and its true underlying or intrinsic value, you're inherently protecting yourself. Against what? Well, against a whole bunch of things. Inevitable mistakes in your own analysis, because nobody's perfect. Unforeseen bad luck stuff happens. Or just sudden, irrational market panic.
Which definitely happened.
Yeah. It's a defense mechanism that, maybe surprisingly, converts the market's inherent volatility into an advantage, not just a threat. You buy low, and that low price absorbs shocks. Price dips become opportunities, not disasters.
Okay, now for the fun one. The famous Mr. Market parable. This really clarifies the emotional side, doesn't it?
It's brilliant. Imagine you have a business partner, this guy named Mr. Market. He shows up at your door every single day without fail. And he's always ready to do business. He'll either offer to buy your shares in the business or sell you his shares.
Okay, sounds convenient.
But here's the catch. Mr. Market is, let's say, emotionally unstable, a bit manic-depressive. Some days he's wildly optimistic, convinced the future is unbelievably bright. He'll offer to buy your shares at exorbitant prices.
Wow, tempting.
Other days he's deeply pessimistic, sees nothing but doom and gloom, convinced everything is worthless. On those days, he'll offer to sell you his shares for next to nothing.
I see where this is going.
The crucial lesson Warren Buffett took from this, and he specifically mentions chapters 8 and 20 of the book, is profound. You are not obligated to trade with Mr. Market just because he shows up. His mood is his problem, not yours. Instead, you use his emotional swings to your advantage. When he's despondent and selling cheap, that's your opportunity to buy more of the business at a bargain price.
Makes sense.
When he's irrationally exuberant and offering crazy high prices, that might be your cue to consider selling your shares to him. The ultimate discipline is to never, ever let his mood dictate your actions or your valuation of the business.
It's a powerful lesson in emotional detachment, turning market noise into potential profit.
Exactly. Strategic patience.
Graham also recognized that not everyone wants to be like a full-time stock detective, right?
Right. Yeah.
He defined two main types of investors.
The defensive investor and the enterprising investor. The defensive investor, they're seeking minimal effort and maximum safety. Think diversification, maybe dollar cost averaging. They want a simple, safe path.
Like most people, maybe.
Probably. Then there's the enterprising investor. This person is willing to put in the work. They'll hunt for bargains, actively monitor their holdings, make decisive actions based on their research. The goal isn't that one is better, but that you need to match your strategy to your own temperament and how much effort you're actually willing and able to put in.
Okay, so how do we apply these ideas today? Graham had specific criteria for the defensive investor. What were they?
Right. Chapter 5 lays these out. They're still surprisingly relevant. First, adequate size. Large, prominent companies. Less risk of going bust suddenly. Second, strong financial condition. He had specific metrics. A current ratio of at least 2, meaning twice the liquid assets to cover short-term debts. And long-term debt shouldn't exceed net current assets, ensuring they weren't overly leveraged. Financial resilience.
Okay, solid financials. What else?
Earning stability. He wanted at least 10 consecutive years of positive earnings. A track record. Dividend record. Continuous dividend payments for at least 20 years. Shows consistency and shareholder focus. And finally, moderate price multiples. A price-to-earnings PE ratio of less than 15 and a price-to-book PB value ratio of less than 1.5 based on averages over the past 3 years.
So valuation matters, even for defensive picks.
Absolutely. Margin of safety applies here too. Now, today, achieving this defensively could be as simple as using low-cost, broad market index funds, or ETFs. You get diversification and market returns without individual stock risk.
Right.
Or if you want individual stocks, but systemically, you could use modern stock screeners. Set filters for low PE, low PB, strong balance sheets, dividend history. Find companies that fit Graham's value, or maybe dividend aristocrat molds.
Automating the criteria.
Exactly. And then there's dollar cost averaging, which he talks about in Chapter 6. Mechanically buying fixed dollar amounts at regular intervals. This forces you to buy more shares when prices are low and fewer when they're high. Turns volatility into an ally. Manages risk beautifully. He emphasized the essence of investment management is the management of risk, not the management of returns. DCA helps with that.
Okay, so for your quick action this week, pick one company you're interested in, maybe one you use or know. Go online. Most financial websites have this info for free, and find its PE and PB ratios. Just compare them to Graham's suggested limits. PE under 15, PB under 1.5. You don't have to buy anything. It's just an exercise. A first step to thinking like a defensive, value-conscious investor. train your eye.
It's a great exercise. And Graham's influence, it's just profound. It goes way beyond his direct students like Buffett. Seth Klarman at Baupost. His whole strategy is built on margin of safety. But even the entire index fund movement, think John Bogle at Vanguard. That traces back to Graham's emphasis on low-cost, diversified investing based on statistical evidence. And modern smart beta factors like value and quality, those also stem directly from his work. His ideas are baked into the modern financial system.
Wow. So what does this all boil down to? Give it to us in one sentence.
Okay. Invest with a margin of safety. Treat market prices as servants, not masters. Match your strategy to you, and then let compounding do the heavy lifting.
Okay, so if Graham teaches you what price to pay, our next classic, Phil Fisher's Common Stocks and Uncommon Profits, teaches you what kind of company to buy. This feels like the other half of the equation, doesn't it? The value growth DNA that shaped Buffett and Munger.
That's a perfect way to frame it, yeah. Published in 1958, so not long after Graham's update. Fisher's work really shifted the focus. It moved away from purely looking at the balance sheet numbers, the quantitative stuff, towards identifying companies that could truly multiply in value, like for decades, by focusing on their qualitative aspects and long-term growth potential. He taught that a truly great business, even if it looks expensive by Graham's strict metrics, could actually be the much better investment over the long run.
Interesting contrast. So what are his core ideas?
Well, I think 4 really stand out.
Okay, the first one, I love this term, scuttlebutt. What's that about? It sounds like gossip.
Huh. It kind of is, but for investing. It's all about getting first-hand qualitative information, not just reading reports. Fisher really emphasized the importance of, literally talking to people connected to the company before you invest. Customers, suppliers, competitors, even former employees.
Really going out and doing detective work.
Yeah. His first chapter is called Clues from the Scuttlebutt Method. He firmly believed that a company's true competitive edge, its real strength or weakness, is often felt in its ecosystem by suppliers, customers, people on the ground, long before it ever shows up clearly in the quarterly financial statements.
So it's like an early warning system.
Exactly. And today, this translates really well to modern tools. We can do channel checks online, look at LinkedIn profiles to see employee churn or excitement, check industry-specific Slack channels or Reddit forums for customer buzz or complaints. Even tracking App Store reviews for a software company gives you direct product-level feedback. It's scuttlebutt for the digital age.
That makes sense. Okay, what's the second core idea? The checklist.
Right, his famous 15-point business checklist. This is really the heart of the book, Chapter 2. It's a systematic filter, but for identifying durable growth companies, focusing heavily on qualitative factors.
What kind of factors are on there?
It's detailed. Things like, does the company have products or services with sufficient market potential to allow for a sizable increase in sales for years? Does it have a strong R&D program relative to its size? An effective sales organization? Above average profit margins? But also things like outstanding labor and personnel relations, real depth in its executive team, not just reliant on one genius. And critically, does it have unique competitive advantages, a moat that's hard for others to copy?
Wow, that's comprehensive.
It is. And he warned very clearly, missing just 1 or 2 vital points on this checklist could cause a stock to seriously underperform for a decade, even if other things looked good. It's about the whole picture of quality.
So find great companies using the checklist and scuttlebutt. Then what? He wasn't big on diversification, was he?
Not at all. That's the third point. Focus, then hold. Fisher was a big advocate of concentrating your investments into just a few outstanding businesses that you've researched deeply. Buy them at sensible prices. He wasn't totally price insensitive. And then, crucially, hold them. Hold through the inevitable market volatility. Let the power of compounding work its magic over years, even decades.
So when do you sell, according to Fisher?
That's in Chapter 4, When to Sell. He gives only 3 valid reasons. 1, you realize you made a mistake in your original analysis. The company wasn't as great as you thought based on the 15 points. 2, the company deteriorates relative to the checklist. Maybe its R&D falters or management quality declines. Or 3, you find a much better opportunity elsewhere, significantly better. But, and this is key, never sell just because the price has gone up or because of normal market fluctuations or economic fears. That's missing the long-term compounding.
Okay, and the fourth idea, the don'ts.
Yes, the 10 don'ts for investors in Chapters 6 and 7. These are essential behavioral rules, really, keeping you from overtrading or chasing fads. Things like, don't buy promotional companies. Don't automatically ignore a great company just because its PE seems high, if its growth prospects are truly exceptional. And don't buy cheap turnaround stories hoping for a quick buck focus on quality. It's about patience and skepticism.
He uses some great case studies, right, in Chapter Now.
Yeah, he shares his own experiences investing in growth stocks from the late 20s to the late 50s. He uses examples like Texas Instruments, Motorola, Dow Chemical to show his 15-point checklist in action, how he applied it.
That must make it really concrete.
Absolutely. These stories show how that rigorous qualitative analysis, understanding the business, not just the numbers, pays off massively over the long term. It really drives home the point that you need to understand the company's operational health, its culture, its competitive moat, its future potential. It's more than just a balance sheet.
Okay, so applying this today, when to buy. She says pay up for quality, even if the PE is above average, if growth is exceptional.
Right. And the best time might be during temporary setbacks or market panics when even great companies get hit. That's opportunity knocking.
What about dividends? Graham liked those.
Fisher had a different take in Chapter 5. He argued that great growth companies should generally retain their earnings if they can reinvest that cash back into the business at a high rate of return higher than their cost of capital. Paying out dividends too early just starves the growth engine. Reinvesting fuels faster compounding.
Makes sense for a growth focus. And applying the 15 points today, you mentioned Glassdoor, LinkedIn.
Yeah, you can leverage modern tools. Glassdoor for culture insights, LinkedIn to check executive backgrounds and tenure, patent databases to gauge R&D strength, alternative data for supplier relationships or customer sentiment. Individual investors can do serious scuttlebutt from their desks now. It makes Fisher's approach incredibly accessible.
Okay, time for the quick action step this week. Think of a product or service you use and genuinely love, something you think is great. Now try to apply Fisher's scuttlebutt method in a small way. Go read the App Store reviews if it's an app. Check online forums or Reddit for discussions about the company or product. Look up Glassdoor reviews for the company that makes it. What new qualitative insights do you gain? Things you wouldn't find in a standard financial report.
It's a great way to start thinking like Fisher and his impact. It's undeniable. Charlie Munger, Buffett's partner, explicitly credits Fisher, along with Graham, for shifting Buffett, moving him from just buying cheap cigar butts to buying great businesses at fair prices. That was huge.
Wow.
Even tech leaders like Bill Gates and Steve Jobs reportedly admired Fisher's focus on long-term innovation pipelines, and his son, Ken Fisher, built a massive multi-billion-dollar investment firm, Fisher Investments, using the core DNA of his father's philosophy. It clearly works.
So the one-sentence summary for Fisher.
Find a handful of truly extraordinary businesses with durable competitive edges, verify their quality through boots-on-the-ground scuttlebutt, buy them at reasonable prices, and then sit tight for years while their earnings compound.
All right, from identifying great companies with Fisher, we pivot now to building a system for greatness itself. Our third deep dive is Ray Dalio's principles, life and work. Dalio, the founder of Bridgewater Associates, famously the world's largest hedge fund, he basically distills 50 years of his own successes and, importantly, failures into this comprehensive decision-making operating system, something you can plug into life, career, and investing too.
This book is really different. It's not just about finance. It's about a systematic, almost like algorithmic approach to life itself. Dalio's core philosophy, the engine behind everything, is captured in this simple, elegant feedback loop. It goes: reality informs your principles, which you convert into algorithms, run those to get results, and then critically, feedback loops connect every stage, constantly refining the whole process.
And it starts with that foundational idea, embracing reality, even when it's painful, and evolving from it.
Yes, Dalio has this famous, almost blunt equation: pain plus reflection, progress. He truly believes every single failure, every mistake, no matter how small or how humiliating, it's not just a setback. It's a profound opportunity to learn and get better.
Okay.
You must first confront reality, however brutal, no sugarcoating. Then, the critical step: write down your principles. Codify what works and why it works based on that reality. Then, take those principles and convert them into clear, unemotional algorithms or rules. This removes emotion from decision-making and lets you scale good decisions.
Like a checklist or a formula?
Could be, yeah. Or just a clear if-then rule. Then you run those algorithms, you execute. Measure the results objectively. Did it work? Why or why not? And then feed those lessons learned back into refining your principles. It's this constant cycle of iterative improvement. Turn every experience into a better principle.
He uses some specific frameworks and acronyms to make this concrete, right? Like Radical Truth and Radical Transparency.
That's a big one at Bridgewater and in the book. It means defaulting to open, brutally honest information flow in an organization or even just in your own head.
Brutally honest sounds tough.
It can be. It's about creating an environment where dissent isn't just tolerated, it's encouraged, where meetings might be recorded for later review, where you critique ideas rigorously but not the people behind them. At Bridgewater, they use this in postmortems after trades went wrong or in risk reviews. Everyone had to be open about mistakes and assumptions.
How could we apply that personally?
Well, maybe by actively soliciting tough, honest feedback after a project, or maybe having a trusted friend or mentor review a big decision you made, asking them to be brutally honest about flaws in your thinking. It's about finding your blind spots.
Okay. Another tool he talks about is the 5-step process for achieving goals. Sounds very practical.
It is. It's a powerful, universal process you can apply to basically anything you want to accomplish. Step 1, set clear, audacious goals. Know exactly what you're aiming for. Step 2, identify the problems or obstacles standing in your way. Be specific. Step 3, diagnose those problems to find their root causes. Don't just treat symptoms.
Right.
Step 4, design solutions or plans to overcome those root causes. Step 5, do it. Execute the plan relentlessly. Push through. He uses this framework for everything, from setting personal goals like OKRs to designing complex trading playbooks. It's very versatile.
Then there's believability-weighted voting. This one's fascinating, giving more weight to opinions based on track record.
Yeah, this is core to this concept of an idea meritocracy. It's about recognizing that, not all opinions are equally valuable on every single topic.
Seems logical, but hard to implement.
It requires discipline. You literally give more weight, mathematically sometimes, to the opinions of those who have a proven, documented track record of expertise and success in that specific area. So in an investment committee meeting, someone who's consistently nailed tech trends gets more say on a potential tech stock than someone whose expertise is, say, bonds or real estate.
Okay.
It forces intellectual humility. It leverages collective wisdom effectively, preventing decisions from being swayed just by the loudest voice or the highest paid person.
Dalio shares a really personal story about Bridgewater almost collapsing in the early 80s, right? How that shaped him.
He does. It's a powerful anecdote. He made a huge public bet that the U.S. was heading for a depression, and he was wrong. Dead wrong. It was a humiliating failure. Almost cost him the entire firm. He had to lay off almost everyone. But that moment of intense pain and the deep self-reflection that followed was the absolute catalyst for his entire principles framework. He realized he needed a much more systematic way to deal with market realities, especially understanding what he calls second and third order consequences, the knock-on effects of events. He learned that the hard way. That experience cemented his core belief. Failure isn't just likely, it's a necessary part of progress if you reflect honestly, extract the lessons, and codify them into better principles. It's the ultimate pain plus reflection progress story.
So let's pull out some key takeaways. Obviously, embrace reality. He says, truth, or more precisely, accurate understanding of reality, is the essential foundation. That's from part 2, Life Principles.
And that formula, pain plus reflection, progress. Failures aren't dead ends. They signal principles that need fixing. A simple application, do a weekly reflection, maybe just 5 minutes. Ask yourself, what stung this week? Why did it sting? What principle could I adjust?
Journaling helps.
He also talks about ego and blind spot barriers. Our own ego can be our biggest enemy.
Huge barrier. His solution, invite trusted peers to grade your decisions or thinking. Create an external feedback loop to catch what you miss. Requires humility. And the idea of systemizing and codifying. Turn recurring decisions into algorithms.
Yeah, this doesn't have to be complex code. It could be as simple as creating standard operating procedure, SOP, checklists for common tasks. Or, for investing, automating watch list scanning based on your defined principles. Removing emotion, ensuring consistency.
Okay, modern tactics from the source. He encourages literally writing down your principles.
Yep. Create a document could be Notion, Evernote, a physical journal titled something like My Investing Principles or My Work Principles. Make it a living document. Update it after wins and especially after losses. Codify what you learned each time.
For believability scores, he suggests actually scoring opinions.
You could do this simply in Excel, maybe score past hit rate on this topic, X stated confidence level. It forces you to think about why you trust certain inputs more than others.
And algorithmize translate principles into if-then logic.
Great. Test them out, maybe in a paper trading script for investments, or even using simple automation tools like Zapier for workflow rules based on your principles.
All right, your quick action step for Dalio this week. Take one decision you usually make on impulse. Maybe it's deciding when to check your portfolio, or how you react to a news headline, or even how you respond to critical feedback. Now, try to apply Dalio's 5-step process, even just mentally. 1, goal, Gauchi, make rational decisions. 2, problem, you can't react emotionally. 3, diagnose, EGAM, triggered by fear go. 4, design, example, pause, gather facts before acting. 5, do it. Even for a small decision, it builds that muscle of systematic, reflective thinking.
Absolutely. And Dalio's ideas, they've really spread beyond just hedge funds. You see echoes in tech culture concepts like radical candor at places like Google, X, and Netflix sound a lot like his radical truth and transparency. His dot collector tool for real-time feedback has inspired features in some financial apps and collaboration software. And the 5-step process is cited by productivity gurus like Tim Ferriss and Naval Ravikant. His influence on systems thinking is pretty broad now.
So the Dalio one-liner.
Codify what works, weight decisions by proven expertise, face brutal reality without letting your ego get in the way, and build relentless feedback loops so your whole life and work machine just keeps getting better.
All right, pause for a second. We've journeyed through the foundational principles of value investing with Benjamin Graham, identified the secrets of finding long-term quality growth with Philip Fisher, and learned how to systematize success itself with Ray Dalio. Wow. What an incredible first half, packed with actionable wisdom.
We've definitely seen how a disciplined approach to price don't overpay, a really keen eye for those qualitative company strengths, the stuff beyond the numbers, and a rigorous feedback loop for decision-making. How these aren't just isolated concepts, they're interwoven threads in the fabric of financial mastery.
Yeah, you can see how they build on each other. It's not just one way to think.
Exactly. It offers a more holistic framework.
Okay, when we come back, we'll dive into how to find those potential 10-baggers, the huge winners, right in your everyday life. That sounds fun. And then a book that honestly challenges everything you probably thought you knew about money and work, pushing you to redefine your entire financial picture. Stay with us. Sponsor break placeholder. Welcome back. Before the break, we were deep into systematic approaches to investing and building wealth. Now, let's talk about leveraging your maybe biggest secret weapon, your everyday life. We're diving into Peter Lynch's one-up on Wall Street.
Peter Lynch, the legend from Fidelity's Magellan Fund. His track record is just staggering. From 1977 to 1990, he compounded capital at, get this, 29.2% per year, turned $18 million into $14 billion.
Insane numbers.
Totally. And his core argument is compelling, maybe even empowering. He argues that the individual investor, the average person, actually has a built-in, undeniable edge over Wall Street professionals if they simply trust what they already see and experience at the mall, on the job, just living their lives.
That's such a liberating idea. You don't need the fancy terminal or the inside scoop.
Exactly. That's his first big idea. Invest in what you already know. Leverage your local edge. His anecdote in Chapter 1 about his caddy tips is classic. He heard pilots bragging about how well they were paid at flying Tiger Airlines.
Because the airline was doing great business.
Right. That led him to investigate and eventually buy the stock, which became a huge winner. His point: everyday observations, what you notice as a consumer, maybe a product flying off the shelves, or as a professional in your industry, seeing a new trend take off these, can often predate formal Wall Street research by months. You see the mania for Crocs or Lululemon or whatever before the analysts do. It's ground-level intelligence.
Okay, love that. But it's not just about noticing, right? You still have to do some work.
Absolutely. That's the second principle. Do the homework, distill it into a simple story plus basic numbers. The observation is just the start. Chapter 7, I've got it, what is it, is key here. He suggests that for every stock pick, you should be able to write or at least articulate a concise 2-minute story or a 2-minute drill.
What goes in the story?
It needs to clearly explain, what does this company actually do? Why will it grow? How does it beat its rivals? And importantly, at what valuation does it look cheap or reasonably priced? This simple exercise forces clarity. It makes sure you actually understand the business, not just the stock ticker or the hot product.
Then he has this system for classifying stocks, right? That seems really useful.
Yes, the third core idea. Classify every stock into one of 6 categories. This is maybe the heart of the book's practical framework. The categories are slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays.
Why categorize?
It helps you set realistic expectations and understand the risks and potential rewards for each type of company. Expecting a stalwart like a big, stable blue chip to suddenly double in 18 months, that's probably unrealistic, though a nice bonus if it happens, but expecting to go 5x, forget it. On the other hand, a fast grower can give you those huge returns, but it becomes dangerous if it matures into a stalwart, but the market still gives it a super high PE ratio. The risks change. Knowing the category tells you what to watch for.
Okay, that makes sense. And he famously talked about tenbaggers.
Fourth idea, look for tenbaggers. The mythical 10x return. Lynch understood that you don't need every stock you pick to be a winner. Investing involves mistakes. But finding just a few tenbaggers over your investing lifetime can more than pay for all the inevitable errors and mediocre performers. It encourages you to look for those truly exceptional growth stories, the companies that can fundamentally change an industry or create a new one. Don't just settle for, okay.
And his final point, ignore the noise.
Fifth principle, ignore the macro noise. Focus on the company, not the Wall Street chatter or economic forecasts. Lynch consistently argued that obsessing over where interest rates are going or what the GDP forecast is next quarter, it's mostly a distraction for stock pickers.
Really? Seems counterintuitive.
For him, it was about focusing on the company's specifics. Is the story still intact? Are earnings growing? Is the valuation reasonable? He felt the macro noise is largely irrelevant to finding individual great businesses that can thrive regardless of the broader economy, or at least recover faster. Find good companies, the rest is noise.
That Flying Tiger Airlines story really sticks with you, doesn't it? The caddy tips.
It's so simple and powerful. It just perfectly encapsulates his core belief. Individual investors have this inherent informational edge because they're out there in the real world. They're observing businesses, products, trends, and actions, stuff analysts stuck behind screens might totally miss until it's old news. It empowers you to trust your own eyes and ears.
Okay, digging into takeaways. What kind of companies did Lynch love? The perfect stock in Chapter 11.
He had a type. He loved boring names. Think automatic. Automatic data processing, payroll processing, not exactly glamorous. He liked ugly duckling sectors, like waste disposal. Industries Wall Street ignored. Spin-offs were a favorite companies spun out from larger parents often unlock hidden value. Companies with patent-protected niches or strong customer captivity, think razor blades, beer, software subscriptions, where once you're a customer, it's hard to leave. And he definitely looked for aggressive insider buying. If the execs are buying big chunks of stock with their own money, that's a huge vote of confidence.
What about stocks to avoid? Chapter 12.
Yeah, he had clear warnings. Avoid the hottest stock in the hottest industry, usually overpriced hype. Avoid diversified conglomerates, companies that acquire businesses they don't understand just to get bigger, often destroying value. Avoid whisper tips, those hot tips from a friend of a friend with no real research backing them, and generally avoid companies in super hot industries where the PE ratios are astronomical, like over 100. Indicates irrational exuberance. Stick to what makes business sense.
His focus was always on earnings, right?
Yeah.
Chapter 13.
Absolutely. Earnings, earnings, earnings. He simplifies it. A stock's value is basically its earnings potential, plus the multiple PE ratio the market is willing to pay for those earnings. And he really popularized tracking the company's earnings growth rate versus its PE ratio. That's the PEG ratio, PE divided by growth rate.
The PEG ratio. I see that everywhere.
Lynch is why. He famously stated that a PEG ratio around 1 is fair value for a growth company. A PEG significantly less than 1 suggests it might be cheap relative to its growth. A PEG much higher than 1 suggests it might be expensive. It's a quick, powerful check. Are you paying a reasonable price for the expected growth?
What about when to buy and sell? Chapters 15 to 17.
Buy after you've done the research, the story, the numbers, the category, and ideally when the market seems to be neglecting it. Add to your position if the company delivers positive earnings surprises, confirming your thesis. And hold through market corrections if the company's fundamental story hasn't changed. Don't panic sell. When to sell. Sell only when the story changes fundamentally or the company changes category, example, fast grower becomes a stalwart, or the fundamentals clearly deteriorate. Not just because the price doubled. He has that great quote in Chapter 20. Selling your winners and holding your losers is like pulling the flowers and watering the weeds. Hold your winners.
Love that quote. Okay, modern tactics based on Lynch. How do we shop and observe today?
Track product buzz using digital tools, Google Trends for search interest, TikTok hashtags to see what's viral, Reddit threads for community discussions about products or companies.
So the 2-minute story.
Write it down. Post a 200-word thesis in a journal, or even on X, formerly Twitter, if you're brave. Revisit it quarterly. Does it still hold water?
Categorizing stocks.
Easy. Just create a column in your tracking spreadsheet. SG, slow grower. ST, stalwart. FG, fast grower. CY, cyclical. TU, turnaround. AP, asset play. Forces you to think about expectations.
And the PEG filter.
Use a stock screener like FINVZ. You can literally screen for PEG 1.5 or 1 for stricter criteria, plus say EPS growth forecast 15%. Finds potential Lynch-style growth at a reasonable price stocks.
Okay, quick action time for Lynch. Next time you're shopping, maybe walking through your neighborhood or just chatting with friends, pay attention. Notice products or services that seem unusually popular or are solving a real problem effectively in a new way. Can you identify the public company behind it? Just doing that observation is your Lynchian local edge in action. It might lead somewhere interesting.
It's a fun way to look at the world. And Lynch's impact, huge. We mentioned Buffett shifted toward sharp growth at a reasonable price, partly because of Fisher and Lynch. That combo was powerful. Retail investors still constantly quote Lynch's local edge examples. Buy what you know is practically a mantra. The PEG ratio is now standard on basically every financial website and screening tool, and the success of Fidelity Magellan under Lynch inspired a generation of growth fund managers and even modern thematic ETFs focusing on consumer trends.
So, Lynch in one sentence.
Use your everyday life to spot promising companies early, do the homework to confirm the fundamentals and classify them correctly, buy at sensible valuations to check that PEG, and then sit tight while earnings and maybe, just maybe, some 10-baggers unfold.
Okay, from the very concrete world of stock picking with Lynch, we shift gears pretty dramatically now. We're moving into a fundamental mindset makeover. Our final deep dive is Robert Kiyosaki's Rich Dad, Poor Dad. This book really framed wealth building as primarily a mindset game, didn't it? It taught millions of middle-class readers to think like owners, not just employees.
Absolutely. Published in 1997, this book became a global phenomenon. And it did two things, I think, that no mainstream money book had really done quite so forcefully before. First, it aggressively, maybe even controversially, refocused the conversation squarely on mindset over just financial mechanics. How you think about money is paramount. Second, and maybe even more profoundly, it pushed readers to fundamentally redefine the basic terms: asset and liability, challenging decades of conventional wisdom.
Let's start there. The assets versus liabilities definition. That seems to be the absolute core of the book.
It is. It's deceptively simple, but the implications are huge. Kiyosaki offers a cash flow-based definition. An asset is something that puts money into your pocket regularly. A liability is something that takes money out of your pocket regularly.
Okay, simple.
But think about what that means. It forces this profound, sometimes uncomfortable reevaluation of everything you thought you owned. He radically pushes you to prioritize buying or building things that generate income passively, rather than just acquiring stuff that looks nice but costs you money or depreciates.
Like a fancy car.
Exactly. Or even, controversially, your primary residence. Kiyosaki often defines your house as a liability, unless it's generating rental income for you.
Why a liability? Isn't it an asset?
From his cash flow perspective, it usually takes money out of your pocket every month. Mortgage payments, property taxes, insurance, maintenance, utilities, it doesn't put money in.
Okay. I see the distinction. It flips the common assumption.
Completely. It's designed to shift you from a consumer mindset to an owner-investor mindset. Focus on acquiring things that pay you.
His second pillar flips conventional wisdom, too. Cash flow first, capital gain second.
Yeah, this is big. He argues that generating consistent monthly passive income is the key to financial freedom. Price appreciation or capital gains, that's just a bonus, the icing on the cake.
That's different from how many people approach investing, right? Chasing the big stock pop.
Very different. He prioritizes building sustainable streams of income from rental properties, dividend stocks, businesses you own but don't run day-to-day, intellectual property, royalties, until those passive income streams eventually cover your monthly living expenses. That's freedom, in his view, not just having a high net worth number that relies on selling assets.
Okay. Third pillar, mindset mechanics. Schools train employees, but self-education trains entrepreneurs and investors.
This is a recurring theme. Kiyosaki emphasizes that the most critical wealth-building skill isn't about mastering complex market charts or knowing every arcane investment vehicle. It's about fundamentally changing your perception of money, of risk, of opportunity itself. It's about cultivating an entrepreneurial spirit, seeing problems as opportunities, being willing to take calculated risks, having a drive to constantly learn and adapt rather than just seeking the perceived safety of a traditional job.
He's pretty critical of the traditional education system.
He is. He views it as largely designed to produce good employees who follow instructions, not necessarily financially independent thinkers or owners. He argues that crucial financial literacy isn't taught.
Which leads to his fourth pillar. Financial IQ can be learned. It's not some innate gift.
Right. He stresses that the core components of financial intelligence, things like accounting, understanding financial statements, investing, how different asset classes work, understanding markets, supply and demand, and navigating the law, taxes, corporate structures, these are all learnable skills. He's a huge advocate for continuous self-education in these areas, reading books, attending seminars, finding mentors. He famously says that learning new skills is often more valuable in the long run than just working solely for a paycheck.
The whole book is framed around his personal story, right? Mm-hmm. The contrast between his poor dad and rich dad.
Exactly. That narrative is the core. His poor dad was his biological father, highly educated, PhD, head of education for Hawaii, but someone who valued job security, pensions, and traditional paths above all else, lived paycheck to paycheck despite a good income. His rich dad was his best friend's father, an entrepreneur with only an 8th grade education, but who built multiple businesses, invested in real estate, and understood how to make money work for him. He valued ownership and financial freedom.
That contrast really drives the point home.
It perfectly illustrates the fundamental mental flip Kiyosaki advocates, shifting your internal dialogue. Instead of saying, I can't afford it, which is a statement that shuts down possibilities, Rich Dad taught him to ask, how can I afford it? Which is a question that opens up problem-solving, creativity, and finding solutions.
It's a switch from scarcity thinking to abundance and entrepreneurial thinking. Find a way.
Precisely.
Okay, let's hit the 6 big lessons he outlines. Lesson 1. The rich don't work for money. They make money work for them.
The core idea. His actionable advice is to list your current income streams, then brainstorm. How could each potentially become asset-backed? Could your job skills fuel a side business? Could savings buy dividend stocks or a rental property? Focus on acquiring assets that generate income without your direct labor.
Lesson 3. Mind your own business. What does he mean by that?
Keep your day job if you need it for cash flow, absolutely. But mentally, your business is your asset column. Pour your surplus time and money into acquiring assets. Real estate, maybe starting a small business, creating intellectual property like a book or course, or buying paper assets, stocks, bonds. His practical tip, commit a fixed percentage of every single paycheck to an asset buy fund. Pay yourself first by buying assets, not just saving cash. Systematically grow that asset column.
Lesson 4 is about taxes and corporations. Sounds complicated.
He simplifies it, the history of taxes and the power of corporations. His point is that the rich often use corporate structures, like LLCs or S-Corp, legally to control their income and expenses for tax purposes. The typical flow for an employee is earn 8, pay tax, A, spend remainder. For a business owner using a corporation, it can often be earn within the core, spend, deduct business expenses, pay tax on the remainder. It offers more flexibility. His advice isn't to evade taxes, but to understand the rules. Consult a CPA about potentially setting up an LLC for side ventures or investments once it makes sense.
Lesson 5. The rich invent money. What does that mean? Finding deals.
Kind of. It means that wealth isn't just about having capital. It's about seeing opportunities others miss. Deals are everywhere if you build your financial knowledge, your network of connections, and your creativity. It's about structuring deals, finding undervalued assets, solving problems for people in exchange for equity or cash flow. His suggestion: get involved. Attend local real estate investment clubs, join online forums, practice analyzing potential deals, even if you don't do them. Learn to spot anomalies and opportunities.
And lesson 6. Work to learn. Don't work for money. We touched on this.
Yeah, it's crucial. He shares his own story of joining Xerox not for the pay, but specifically to conquer his crippling fear of sales. He knew sales skills were essential for entrepreneurship. His advice: take jobs sometimes purely for the skills they will teach you: sales, marketing, management, negotiation, not just for the title or the immediate paycheck. And don't be afraid to move on. If your learning curve flattens out after 3-5 years, consider rotating roles or companies to keep acquiring valuable skills.
He also talks about overcoming common obstacles in Chapter 7, right? Fear, cynicism.
He addresses the big ones. Fear of losing money. Calculate the realistic worst-case scenario, accept it, have backups, start small. Cynicism, listening to naysayers. Verify facts yourself. Ignore rumors and unfounded negativity. Focus on your analysis. Laziness, procrastination, his cure. A little healthy greed. Focus on the benefits of acting. Pay yourself first by automating asset purchases. Bad habits, spending first. Budget for assets first, then live off the rest. Control your spending. Arrogance, thinking you know it all. Admit what you don't know. Stay humble, keep learning. Arrogance leads to costly mistakes.
Okay, modern tactics. How do we apply assets first today?
Automation is key. Set up automatic transfers from your checking account directly into a brokerage account to buy dividend ETFs like SPY, QQQ, VYM, or into a REIT fund or a real estate crowdfunding platform. Make buying assets automatic.
Tracking cash flow.
Use financial apps, WineRE, Need a Budget, Tiller Money, which uses spreadsheets, Mint, Personal Capital. Many can help. Set up a dashboard specifically showing your asset income versus your liability expenses using his definitions. Visualize the progress.
And the education loop.
Make it a habit. Commit 30 minutes a day to reading financial news, books, blogs, and maybe once a quarter, take an online course on Udemy, Coursera, or Skillshare related to investing, real estate, or starting a business. Continuous learning.
All right, the quick action for Kiyosaki. Grab a piece of paper, literally. Draw 2 columns. Label one assets and the other liabilities. Use Kiyosaki's definitions. Puts money IN versus I co-OA. Takes money OUT. Now, list everything you own and major recurring payments into one of those 2 columns. Your car payment, liability, dividend stock, asset, your house payment, probably liability, student loan, liability, rental income, asset. It's a surprisingly powerful visual exercise. Really redefines your financial picture instantly.
It really does. And Kiyosaki's impact, it's just immense. Love him or hate him, he arguably sparked the entire modern financial freedom movement. FIRE, financial independence, retire early, owes a huge debt to him. That core mantra, focus on assets over your paycheck, is now completely widespread in personal finance discussions online and off. Now, he's certainly been criticized, fairly, for oversimplification, maybe some unverifiable stories, but his motivational power, undeniable. Even someone like Warren Buffett has acknowledged that having the right mindset is a critical piece of the puzzle, even if Kiyosaki's specific investment advice isn't Buffett's style.
So the Kiyosaki summary in one sentence.
Shift from an employee mindset to an asset owner mindset. Commit to mastering financial literacy and systematically buy or build cash-flowing assets until your passive income eventually exceeds your living expenses.
Okay, we've just unpacked 5 incredible foundational classics. Each one is a gold mine on its own, right?
Right.
But here's where it gets really interesting, I think. What happens when we start combining their wisdom? Layering these powerful ideas, we put together 3 powerful cross-book power moves for you, showing how these seemingly separate ideas actually reinforce and strengthen each other.
Yeah, these aren't just, theoretical exercises. They demonstrate how combining these principles creates a truly robust, more resilient approach to investing and wealth building. They show the synergy. You don't just have to pick one philosophy. You can integrate the best parts of several.
Okay. Power move number 1. We're calling it the boots-on-the-ground research engine. This one blends Fisher's Scuttlebutt with Lynch's Invest in What You Know and his Mall test.
Right. So Fisher taught us the immense value of getting that qualitative information right, talking to customers, suppliers, competitors to really understand a business from the inside out.
The Scuttlebutt.
Exactly. Then Lynch comes along and shows us that our everyday life, what you observe at the mall, on your job, just noticing consumer trends, gives you this incredible early informational edge.
So how do they combine?
The combined action is this. Use your daily observations, your Lynchy local edge, to identify potential companies that seem to be genuinely thriving or solving problems really well. Then, immediately apply Fisher's Scuttlebutt process, but using modern tools. Jump on LinkedIn to see who works there, how long they stay. Check Reddit subs for what real customers are saying. Look at Glassdoor reviews for employee morale. Analyze App Store reviews for product strengths and weaknesses. This qualitative deep dive, sparked by your real-world observation, can often give you insights months before formal Wall Street reports catch up. It's a true informational advantage.
Love that. Okay, power move number 2. The Quality Value Fortress. This brings together Graham's fundamental margin of safety with Fisher's rigorous 15-point business checklist.
Okay, so Graham teaches the absolute necessity of paying a sensible price, right? Often a discounted price, ensuring that wide gap between price and intrinsic value, your protective cushion. Don't overpay.
The margin of safety.
Then Fisher gives you that rigorous, systematic framework, the 15 points, to identify truly high-quality businesses, companies with durable competitive advantages, strong management, good prospects, the potential to compound value for decades.
So value plus quality.
Precisely. The combined action. Don't just buy cheap stuff, which was early Graham Buffett. Instead, buy quality companies identified using Fisher's meticulous checklist, but only when they are available at cheap or reasonable prices that offer a Graham-style margin of safety.
That sounds like modern Buffett.
It is the core shift Munger helped Buffett make, moving from cigar-butt investing to buying great businesses at fair prices. You're not just finding any beaten-down asset. You're identifying companies with strong R&D, great management, competitive moats, but disciplined enough to wait for a price that builds in that safety buffer. That's a fortress.
Makes total sense. All right, power move number 3, the automated asset builder. This combines Kiyosaki's core lesson, build that asset column, with Dalio's 5-step process for achieving goals and his drive to algorithmize principles.
Okay, Kiyosaki fundamentally shifts your mindset, right? Prioritize acquiring cash-flowing assets over just earning a paycheck and spending it all. Build passive income.
Mind your own business, your asset column.
Exactly. Then Dalio provides the systematic, almost engineering-like framework, the 5 steps, the feedback loops to make anything, including your wealth building, a self-improving machine for progress.
How do they work together?
The combined action. First, define your asset-building goals Kiyosaki style. Be specific. ACG, achieve $1,000 a month in passive income from dividend stocks within 3 years. Then apply Dalio's 5-step process to that goal. 1, goal defined. 2, problems. ACG, not saving enough, don't know what stocks to buy. 3, diagnose ACG spending habits, lack of knowledge. 4, design solutions. ACG, budget rigidly, automate savings, create investment criteria checklist. 5, do it. And crucially, algorithmize your asset acquisition, as Dalio would say. Automate those transfers to your brokerage account or refund every payday. Codify your asset criteria into a simple checklist based on Graham-Fisher-Lynch principles that removes emotion from your buying decisions. This turns your wealth building from a sporadic effort into a robust, systematic, self-improving system that compounds your money, your knowledge, and your discipline.
Wow, those cross-book power moves really show how interconnected these timeless principles are, don't they? It's not just separate advice. Now it's your turn to engage with this deep dive. We want to hear from you. First up, our poll question for you today is, which book will you read or reread first after listening to this deep dive?
Your choices are The Intelligent Investor by Benjamin Graham, Common Stocks and Uncommon Profits by Philip Fisher, Principles, Life and Work by Ray Dalio, One Up on Wall Street by Peter Lynch, or Rich Dad Poor Dad by Robert Kiyosaki.
Cast your vote on our website or social media. We're really curious to see what resonated most with you right now and where you'll start your deeper learning journey.
And then for our Q&A prompt, we want to hear directly from you about taking action. Tell us the single principle from today's deep dive that you'll commit to applying in the next 30 days.
Maybe it's practicing Scuttlebutt by checking some app reviews for a company you follow. Or actually drawing out your personal asset liability columns like Kiyosaki suggests.
Or maybe it's starting to define your own investment principles using Dalio's framework. Whatever it is, share what you're committing to.
We'll be looking through your responses, and they might spark ideas for future discussions. Your application is really the most important part of all this. We've covered an incredible amount of ground today, haven't we? Diving deep into the minds, the frameworks that built these billionaire mindsets, from Graham's essential margin of safety to Fisher's hunt for quality, Dalio's systems, Lynch's local edge, and Kiyosaki's asset mindset. These aren't just, dusty historical texts. They feel like living, breathing guides for navigating the complexities of finance and, honestly, life.
Absolutely. And remember, becoming truly well-informed, building that financial IQ, it isn't about memorizing a list of facts or formulas. It's about deeply understanding the underlying principles, adapting them to your own situation and temperament, and then continuously refining your approach through experience, reflection, and, probably some mistakes along the way. That journey of gaining knowledge, reflecting, and improving, that is, in itself, an invaluable asset.
So what does this all mean for you, the listener, the learner? I think the real secret to lasting wealth, to profound success, isn't finding some single golden ticket or secret formula. It's really in the relentless pursuit of learning, that honest self-reflection Dalio talked about, and disciplined, consistent action. It's about turning every experience, good or bad, into a new principle for progress, building your own operating system. Join us next time on The Deep Dive as we switch gears completely and unravel the fascinating complexities of the neuroscience of decision-making. How does your brain actually make choices, especially under pressure?
Ooh, that sounds fascinating, linking the brain to behavior.
It should be great. Until then, keep digging, keep learning, and keep applying.